Squawk Box. Yesterday was a rough one for regional bank stocks. Trading halted and restarted multiple times for more than a dozen names during the session because of volatility. That volatility had people scrambling to find out if their money was safe. Senior personal finance correspondent Sharon Epperson with us now to talk about what you need to know about FDIC insurance and what you think that implicit guarantee, if you think it is implicit, really is.
Absolutely, Andrew. To protect your money over the long run, it's important to understand what is insured and what is not. The Federal Deposit Insurance Corporation, or FDIC insurance, does not cover stocks, bonds, mutual funds, exchange-traded funds, or crypto assets, or what you may have in a safe deposit box at a bank. What FDIC insurance does cover?
Crypto assets, as you can see, is not covered, unfortunately. Well, not yet, at least.
Your cash, up to $250,000 per depositor, per bank, per ownership category. Coverage is automatic whenever a deposit account is opened at an FDIC-insured bank. That includes checking, savings, money markets accounts, and certificates of deposit or CDs.
Also, certain retirement accounts, revocable trusts, irrevocable trusts as well.
And you may even find you can get more than $250,000 insured through that same bank.
Call your banker and see what and how they can assist you in protecting what you have with them. Because in many cases, especially the larger banks, you're going to have the ability to protect more than the 250 through some of the avenues and channels they have available.
Now, one of those avenues may be a bank network, like the IntraFi Network Deposit Program. If you ask your bank for additional FDIC coverage, here's how it could work. Say you have $1 million in your name at one bank. The first $250,000 is automatically insured at that bank. If they participate in this network, then the next $750,000 would be divided among several other banks, with no one bank having more than the insurance limit. You could also do this yourself by opening accounts at different FDIC-insured banks, Andrew.
How does it work if you have, let's just say if you have a joint account, for example, does that count twice?
Yes. So it's per depositor. So if you have a joint account, it will be up to $500,000 in that account for two people.
And by the way, what's the benefit? I mean, I understand the benefit might be easier. The idea that you can use, you can have one bank that then spreads the money out of three banks versus you doing it yourself. Is there an advantage either way?
The advantage is just someone else is doing it.
Doing it for you.
You don't have to do it, you don't have to do it yourself.
Banks you're trying to keep track of,
Exactly.
which would be a serious pain in the
So, but it looks like all the money is still sitting in one account. Or no?
It's in different accounts, but that bank is helping you manage and making sure that that it's in the accounts, but not over the limit.
Okay.
And they may also, if you start to get more interest and you get over or close to that limit, they may move it to another bank. So just keeping their eye on it, I think, is really important.
Okay, Sharon.
Since 1933, the FDIC seal at banks and financial institutions has signified trust and stability to millions of Americans. FDIC deposit insurance is backed by the full faith and credit of the United States government. Since the FDIC's inception, no depositor has ever lost a penny of FDIC-insured deposits. FDIC deposit insurance enables consumers to confidently deposit their money at FDIC-insured banks across the United States, and in the unlikely event of a bank failure, guarantees they can get their insured deposits back promptly. These deposits and official items qualify for deposit insurance coverage at an FDIC-insured bank. However, some investments are not insured, even if they were purchased at an FDIC-insured bank. The insurance coverage limit is $250,000 per depositor, per ownership category, per FDIC-insured bank. It's important to note that all the deposits that a depositor has in the same ownership category at the same bank are added together and insured up to the standard maximum deposit insurance amount for that category. Owners of accounts in different ownership categories may qualify for more than $250,000 in protection. To ensure that consumers understand how deposit insurance works, the FDIC provides many resources, including access to deposit insurance experts to address your unique situation. To determine coverage limits, the FDIC insures accounts based on their ownership category. A single account is a deposit account owned by one person with no beneficiaries. All single accounts at the same bank are added together and insured up to $250,000. A joint account is a deposit account owned by two or more people with no beneficiaries. Each co-owner's share of all joint accounts at the same insured bank are added together and insured up to $250,000. Self-directed retirement accounts are insured under the Certain Retirement Accounts ownership category. If an individual has more than one eligible self-directed retirement account at the same bank, the FDIC adds up the deposits held in each account and insures the total amount up to $250,000. Revocable trust accounts and irrevocable trust accounts are two distinct ownership categories that involve deposits that name beneficiaries. These accounts must meet specific requirements for the owner to qualify for per-beneficiary deposit insurance coverage. Specific coverage amounts depend on the type of trust and the number of beneficiaries named by the owner. Business, employee benefit plan, and government accounts also qualify for FDIC insurance. Understanding how the deposits you keep in a single bank are insured by the FDIC is as easy as visiting FDIC.gov. At FDIC.gov, you can calculate the insurance coverage of your accounts with EDI, the Electronic Deposit Insurance Estimator. Learn if your bank is FDIC insured, find more detailed deposit insurance information, and access contact information for FDIC assistance. The FDIC is available 7 days a week at 877-ASK-FDIC. That's 877-275-3342. Banks offer a variety of personal accounts to meet your financial needs. Let's walk through the FDIC coverage for the three most common types. A single account is just that, a deposit account owned by just one person without named beneficiaries. An account established by an agent or custodian, a business account for a sole proprietorship, or an account representing a deceased person's funds. The FDIC adds together all single accounts owned by the same person at the same bank and insures the total up to $250,000. At her bank, Maggie has 4 different types of single ownership accounts totaling $260,000. How much of Maggie's $260,000 is insured by the FDIC? $250,000 is insured, while $10,000 is uninsured because it exceeds the coverage limits for single accounts. Maggie also owns a joint account with her husband. A joint account is a deposit account owned by 2 or more people without named beneficiaries. Each owner must have equal rights to make withdrawals and have signed the deposit account signature card. Electronic signatures also meet this requirement. Each co-owner's share of every joint account at the same insured bank are added together, and the total is insured up to $250,000, assuming all co-owners have equal ownership. Maggie and her husband co-own 3 different joint accounts containing $530,000. If Maggie and her husband have equal ownership of these joint accounts and own no other joint accounts at that bank, how much is each of their shares insured for? Of the $265,000 that belongs to each of them, they each are insured for $250,000, and each of them is uninsured for $15,000. Maggie is also planning for her future, so she contributes to her self-directed retirement accounts. A self-directed retirement account is an individual retirement account or a self-directed defined contribution plan, like a 401k or profit-sharing plan. Maggie keeps 2 types of self-directed retirement accounts at her bank, a traditional IRA and a self-directed profit-sharing plan worth a combined $215,000. How much of it is insured? All of it, because it is under the FDIC's $250,000 insurance limit for certain retirement accounts. Structuring your accounts to maximize your FDIC insurance coverage will ensure that you will not lose a penny of your insured deposits in the unlikely event of a bank failure. Less commonly used personal accounts include trust accounts and employee benefit plans. For more information, visit us at FDIC.gov, where you can calculate the insurance coverage of your accounts with our Electronic Deposit Insurance Estimator, find more detailed deposit insurance information, and obtain contact information for FDIC assistance. The FDIC is available 7 days a week at 877-ASK-FDIC. That's 877-275-3342.